Hey everyone, welcome back to Corporate Decoder, the place where we break down those confusing corporate reports into plain English, and sometimes we find some juicy details buried in the numbers. Today we are diving into Rocky Brands Incorporated's latest quarterly report, the one that shows us how they are doing in the hot summer months and heading into fall. So what is Rocky Brands Incorporated all about? They make footwear and apparel, boots and clothes for work outdoors and even western wear under brands like Muck and Rocky. They are trying to outfit you from head to toe. Let us jump straight into their financial picture, starting with what they own. As of the 30th of September 2025, Rocky Brands had total assets of about $494 million. This is a bit higher than the $457 million they had at the end of 2024. Their inventory alone is a pretty big chunk of this, standing at over $193 million. That is a lot of boots and jackets. That inventory figure is up from $166 million at the end of last year. This increase in inventory on their balance sheet is something to keep an eye on. The company mentioned it is due to increased costs from tariffs imposed in 2025 and likely stockpiling to meet expected demand for the upcoming holiday season. Now, for what they owe, total liabilities are around $247 million. They have accounts payable and other current liabilities making up a chunk of this. Their long-term debt is sitting at about $130 million. This is down from around $141 million at the same time last year. That is a good sign they are chipping away at their debt. Looking at shareholders' equity, we see that Rocky Brands paid out about $1.1 million in dividends in the 9 months ending in 2025 and a similar amount in 2024. This shows they are returning some profits to their owners. Turning to their performance, the company brought in $122.5 million in net sales in the third quarter of 2025. This is an increase of about 7% compared to the same period last year, which was $114.5 million. They also saw an increase for the first 9 months of the year, with sales reaching $342 million, up from $325 million in 2024. Good to see revenues going up. This increase in sales translated into a healthier profit margin. Their gross margin, which is basically what is left after they pay for the cost of making their products, improved significantly. For the third quarter, it was 40.2%, up from 38.1% last year. For the first 9 months, it was 40.8% compared to 38.6%. This suggests they are managing their costs better or can charge higher prices. They mentioned price increases and a favorable shift in their product mix, especially with their rubber boot brands doing well. However, their operating expenses also went up. For the third quarter, they spent $37.5 million on things like running the business and marketing, that is 30.6% of their net sales. This is up from 29.3% of net sales last year. The reason they give is higher logistics costs and an increase in marketing efforts likely to drive those retail sales. For the first 9 months, operating expenses were 32.7% of net sales compared to 31.7% in 2024. Despite the rise in operating expenses, their income from operations before interest and taxes actually increased. It hit $11.7 million in the third quarter of 2025 compared to $10.1 million a year earlier. For the first 9 months, income from operations was $27.6 million, up from $22.6 million. So overall, they are generating more profit from their core business. One piece of good news is that interest expense went down significantly. For the first 9 months of 2025, it was $7.4 million, a big drop from $14 million in 2024. This is because they have paid down debt and also because interest rates have come down. Their income tax expense is pretty stable. For the third quarter, it was 20.3% of pre-tax income. For the first 9 months, it was 22.1%. These are reasonable numbers. And finally, the bottom line, the net income. Rocky Brands reported a net income of $7.2 million for the third quarter of 2025. This is up from $5.3 million in the same quarter last year. For the first 9 months, net income was $15.8 million, a solid increase from $6.6 million in 2024. This means the company is becoming more profitable. Digging deeper into the notes, we see they are keeping an eye on their tax filings. They are currently evaluating new accounting standards for income tax disclosures and expense disaggregation, but do not expect a major impact. They also mentioned that they have been affected by new international tax laws as of July 2025, but do not see it materially changing their financial statements. When it comes to managing their assets and liabilities, Rocky Brands uses a fair value approach. For things they deal with daily cash receivables and payables, their value on the books closely matches what they are worth. For their credit facilities, they consider it a level 2 asset, meaning its value is based on observable market data, not just their own predictions. Let us talk about revenue. Rocky Brands has 3 main ways they make money. They sell to other businesses wholesale. They sell directly to you, the customer, retail, and they make products for other companies, contract manufacturing. Revenue is recognized when they give control of the product to the customer, usually upon shipment. They also mention that taxes collected from customers are not counted as revenue, which is standard practice. On the topic of money owed to them, Rocky Brands has an allowance for credit losses. This is basically a buffer for customers who might not pay. As of the 30th of September 2025, this allowance was about $0.8 million, which is a small number compared to their total receivables. We touched on inventory earlier, but let us look at the breakdown. Most of it is finished goods, over $174 million, with the rest being raw materials and work in progress. Rocky Brands also has goodwill and other intangible assets from past acquisitions. Their goodwill remained unchanged at around $47.8 million. Their identified intangibles like trademarks, patents, and customer relationships are worth about $103.7 million. Notably, a key detail is that there was an impairment to the Muck brand in 2024, which sounds like they had to recognize a loss in value for that brand. Now, about that long-term debt we saw earlier, in April 2024, they refinanced their loans, resulting in a $175 million asset-based lending credit facility and a $50 million term loan. Right now, they have about $40 million of borrowing capacity available under this lending facility. The interest rates are variable depending on how much they borrow and the type of loan it is. They reported being in compliance with all their loan covenants, which is good, not triggering any issues. It is specified that they must maintain a minimum fixed charge coverage ratio. As of the 30th of September 2025, they were in compliance with all these requirements and restrictions on things like paying dividends and buying back stock. Back to taxes, their effective tax rate for the 9 months of 2025 was 22.1%, which is slightly lower than 23.4% in 2024. They are still assessing some new tax disclosure rules, but do not expect material changes. Let us look at earnings per S-hair. For the third quarter of 2025, basic earnings per S-hair was $0.96 and diluted earnings per S-hair was also $0.96. For the first 9 months of 2025, diluted earnings per share was $2.10 up from $0.88 in 2024. This shows a significant improvement in profitability on a per share basis. They also mentioned stock options. While some of these can dilute earnings per S-hair for Rocky Brands, their impact was minimal in these reports. The company did note a net loss in a previous period that resulted in 0 dilutive share units being included because it would have been anti-dilutive, meaning it would have inflated earnings per share incorrectly. Breaking down their business further by segment, we see that wholesale is their biggest revenue driver, bringing in about $89 million in the third quarter. Retail is growing fast with $29.5 million in sales, that quarter up 10.3%. Contract manufacturing is smaller with about $3.9 million in sales. For the year-to-date wholesale, sales are $237 million and retail sales are just under $96 million. The retail segment is showing stronger growth and accounts for a higher gross margin than wholesale. In terms of legal stuff, Rocky Brands is involved in some lawsuits, but they feel the risk of any major negative impact is small. They also have a gain contingency related to overpaid import duties from 2021 and 2022 for acquired brands. They think they might get back about $7.9 million and have already received $5.1 million. They are not counting this as guaranteed revenue yet until they get the money. Looking at the bigger picture, management highlights increasing tariffs on imported goods as a challenge. They are trying to counter this by shifting some sourcing to their own manufacturing facilities in the Dominican Republic and Puerto Rico. They also note a shift in their sales mix, with retail growing faster than wholesale. Some key highlights from their earnings release are a 7% increase in net sales for the third quarter and a 210 basis point improvement in gross margin. Inventories are up as we saw, and total debt is down. For the year to date, they saw a 5.1% increase in net sales and gross margin improved by 220 basis points. Operating income as a percentage of net sales also increased, and net income per diluted share saw a good jump. On liquidity, Rocky Brands feels they have enough cash and access to their credit lines to keep operations going and invest in growth. They have $3.3 million in cash and $40.1 million available under their credit facility as of the 30th of September 2025. Their working capital fluctuates with the seasons. Cash flow from operations was actually negative in the first 9 months of 2025 at $1.3 million, which is a big change from the $28.4 million provided in 2024. This is largely due to that big increase in inventory. They had to spend more cash to buy that inventory. Investing activities show they spent $5.7 million on things like equipment, and it in 2025. Last year they spent less on investments, but also received $1.7 million from selling the service brand. Financing activities activities show a positive cash flow of $6.6 million in 2025, mainly from borrowing more than they paid back on their credit lines plus paying down some term debt and dividends. This is a turnaround from 2024 when they used $27.7 million in financing. They also announced a share repurchase program in February 2025 to buy back up to $7.5 million worth of their stock. Now for the risks, the big one they highlight is the impact of additional tariffs on imported goods from countries like China. This could increase their costs and reduce profits. They are trying to mitigate this by moving some manufacturing to their own facilities, but there is no guarantee this will fully offset the impact. They also mentioned that these trade actions could harm the value of their intangible assets like brand names. They also state there were no unregistered sales of equity securities and no applicable use of proceeds from any registered offerings for this period. So what is my take on Rocky Brands Incorporated after reviewing this filing? Well, on the surface things look pretty good. Their revenue is up, their profit margins are improving, and their net income has seen a significant increase compared to last year. They are also managing their debt well by paying it down and have access to credit if needed. The growth in their retail segment is a positive sign as it generally carries higher margins than wholesale. However, there are a few red flags to consider. The significant increase in inventory is not ideal unless it directly translates into higher sales in the short term. If demand falters, they could be stuck with a lot of unsold goods. The increasing operating expenses as a percentage of sales also warrant attention. While some of that is due to growth strategies, it needs to be monitored to ensure it does not eat into those improved gross margins too much. The biggest external risk remains those tariffs and trade policies. While they have a plan to navigate this, it is a significant unknown that could impact their costs and profitability unexpectedly. Overall, Rocky Brands appears to be navigating a challenging environment reasonably well, improving its core profitability and growing its retail presence. The key for them will be continued disciplined inventory management and successfully mitigating the impacts of global trade policies. Alright, that is our breakdown of Rocky Brands' latest filing. What do you think about their inventory levels and their strategy to deal with tariffs? Let me know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into corporate documents. And don't forget to check out our Discord community linked in the description for even more discussions and insights. Thanks for watching, and I will see you next time on Corporate Decoder.